there, everyone who wants to purchase, their affordability is going to decrease by somewhere between 8 and 10%. So huge impacts.
The Bank of Canada just raised interest rates a full percent. That is 100 basis points.
Today, we raised the policy interest rate by 100 basis points, 1 percentage point. An increase of this magnitude in one meeting is very unusual. It reflects very unusual economic circumstances.
So what is going to happen moving forward with the housing market, and how is this going to affect our economy broadly speaking? Hi, my name is Adam. I'm the owner of Vision Real Estate. Thanks so much for tuning in again. And if you haven't already, please feel free to hit the subscribe button below and to the right of you. And if you also would like to get a notification every single time I put out a new video, hit the bell and don't forget to like this video. And if you haven't taken me up on my offer yet, please feel free to scroll down and click the link in the description below where you will be connected directly to my calendar. If you have any questions about real estate, you can book a 15-minute chat with me at your convenience, or feel free to just email me to adam@visionrealestate.ca with any question you might have, and I will send you a personal response with my opinion within 24 hours. So I tried to shoot and edit this video really quickly because this news just came out today as I'm shooting this, and it's big news. The housing market had already taken a beating, and I think we're at around a 16% drop in price since February for the Toronto Real Estate Board. So another full 100 basis point increase in the overnight rate from the Bank of Canada is going to have a massive impact on an already soft market. Now I want to jump straight into the finances of it first and how this is actually going to affect the mortgage market, because that correlates directly over to the housing market in terms of pricing, which I know everybody is really going to be curious about the most. And because I'm not a mortgage professional or mortgage expert, I called in the reliable, as always, Jeff Mudrick, who is a mortgage expert in the area that I work in, for his 2 cents on what's going on, and here he is. What exactly is happening? Give us a breakdown of what's going on.
All right, this is like the anticlimactic Super Bowl for mortgage brokers because our phones are ringing off the hook. It is nonstop. So essentially what happened, you're right, the Bank of Canada increased the overnight lending rate by a full percent, which is higher than most people had predicted. It has happened once in the 90s, but we have not seen anything close to this for the last 23 years. It's been very steady, minus the 2007-2008 bump. For the past 12 years, it has pretty much been a flat line when it comes to prime, with a little bit of up and down. But especially over the past 4 years, it's only gone down. So obviously we knew that rates would increase, but they've increased a total of 2.5% in the last 6 months, which is pretty alarming considering the fact that rates, when we talk about prime, for example, prime was 2.25% for the last couple of years. And then in the last 6 months, it's increased up to 4.7% now. 2.4% was prime. Now prime is 4.7%. So huge increases over the past 6 months. And how this affects, first of all, how does it affect current homeowners? After this increase, you can expect your mortgage payment to increase by about $50 for every $100,000 that you owe. So for example, if you owe $500,000 on your mortgage and you have an adjustable rate mortgage, which is kind of like a variable rate mortgage, your monthly payment is going to increase by about $250 a month. If you have $1 million mortgage, your monthly payments are going to increase by about $500 a month. So that is how it's going to impact people who currently own a home. When we talk about how is it going to impact people who want to get into the market, essentially everyone has to get pre-approved one more time. So whether that is talk to your bank, talk to a mortgage broker, talk to your mortgage specialist, somebody that you trust to pre-approve you again. Hopefully that person's already reached out to you or will reach out to you in the coming days to pre-approve you again. But the reason why that is because when you were pre-approved, you were pre-approved to purchase at the current variable rate minus a certain percent. So prime minus a certain percentage. Because prime has skyrocketed by a full percent overnight, every borrower out there, everyone who wants to purchase, their affordability is going to decrease by somewhere between 8 and 10%. Big
Wow.
numbers.
So your purchasing power effectively, and this is regardless of a rate hold. If you had a rate hold, this doesn't even save you. Your purchasing power is cut by 10%. So if you were shopping for $1 million home before, now you have to shop for a $900,000 home.
Yeah, I ran the numbers today, and it is essentially that exact situation. So if you are wanting to buy, if yesterday you could buy $1 million home and you were going to put down 20% or $200,000, today with that same $200,000 down payment, you can afford a $900,000 home, maybe 910 if you push it.
Wow.
So huge impacts. And yes, you're right. So rate holds, they're great because at least you have something locked in. What you have locked in is a discount off of prime. So if prime fluctuates, which it did this morning, about 4 hours ago, if prime fluctuates, then your discount off of prime remains the same. But when you do purchase the home, you're going to have to requalify at whatever that rate is at the time. So right now it's increased by a full percent. You have to requalify at a full percent higher.
Wow. Okay, so talk to me a bit about rate holds and what those are, and what pre-approvals are and what those are, and what the common misconceptions are around those, because a lot of people, I think, feel like if they get a rate hold that they're safe. What is exactly the case with that?
So that is the case for some people. So people who got a fixed rate hold, if they're pre-approved with a fixed rate, you're fine. There's no worries. You're qualifying as the same amount because we already had to qualify you at a higher percent. So if you're qualified with a fixed rate or quote unquote pre-approved with a fixed rate mortgage, there's no worries. If you were pre-approved with a variable rate mortgage, what that means is we've locked in a discount off of prime. And because prime has fluctuated, I'm going to share my screen now and show you. Because prime has fluctuated, all you see on a pre-approval is this. So principal mortgage amount, these clients qualified for 1.14. Essentially, what you see in a pre-approval is the clients are approved for the prime minus 0.45%. So currently on this pre-approval, prime is 3.85%. And now this prime is going to be 4.85%. This is this specific lender's prime. We don't need to get into that. So what the discount off of prime is, we will hold the 0.45% variance until X date, but they're not holding prime for us. So when we go and actually apply and purchase a property, this is what is going to hurt a lot of clients if they don't reach out to their mortgage broker before purchasing a property.
In terms of people who have already bought and are now going to close, but haven't closed yet, how does this affect those people?
Fantastic question. So anyone who purchased this morning before 10 o'clock or earlier, there's no impact on them in terms of qualifying for a mortgage. As long as their mortgage broker had applied, then they're fine. At the date that you apply is the day that whatever the prime is at that time, that's how you qualify. So the only impact, or the big impact that this will have on clients waiting to close on a property, is that their mortgage payments are going to be higher than what is on the commitment letter, than what they spoke to their mortgage broker about, which is why even if you've already purchased a property, I would personally recommend reaching back out, having the mortgage broker run quick numbers and let you know, update the budget spreadsheet and let them know exactly what your new payment is.
But a lot of people shop at the top of their budget. So what if someone purchased at their absolute max? What happens then?
From a qualifying standpoint, or just from a monthly budget standpoint?
Yeah, like can the bank turn around and say, hey, listen, like you shopped at your max and now we can't fund this deal?
I would say no, unless there's some drastic change to the application and the lender is concerned about something. No, typically if clients are waiting to close, and as long as there's nothing outstanding, the conditions are all satisfied, there's no concern. So for example, I had a client purchased on Monday. We got all the hard work out of the way done. Clients were broker complete, and this has no impact on them, even though they did shop right at the top end of their budget.
Another question for you. So what are variable rates at right now?
Variable rates are currently sitting at prime minus 0.3 to 0.9%, depending on if you're putting 20% down, less than 20% down, purchasing over $1 million, under $1 million. There's a lot of different factors. So if we take 4.7%, which is the new prime, and minus 0.3, that means variable rates are sitting at 4.4%. If you're putting less than 20% down, we can still get prime. We can still get your variable interest rate at 3.8%.
Okay, so here's, I think the question on everybody's mind is the actual impact on the economy, on the market in general. Did they allude to any more hikes coming after this? Is this just fasten your seatbelts, we're going to be doing this some more?
There's a few different theories out there, though. One is, hey, we did this full percent now so that we don't have to do a huge increase in September when the next announcement's going to be made. Another theory is, hey, hold on, because this is going to continue for a little bit. And I've heard some that say this is the last one for the year. So, depending on who you read, what you want to hear, that's probably what you're going to read. So the advice is, it's no way to, just like you can't predict the real estate market, it's impossible to time like the financing side of things as well. So all you can do right now is have the information that we have, process the information that we have, and act on it, act on it as best you can.
What would you recommend people do in this climate if they're shopping for a home?
100% get pre-approved. If you have already been pre-approved, get pre-approved again. The process should be just as simple as it was the first time. That is without a doubt what they should do. My personal opinion with the market, I usually defer this stuff to realtors like yourself. My guess is because every buyer's buying power is going to decrease between the 8 and 10% mark. Housing prices, probably, it makes sense that they follow. Maybe they're not dropping 10%, but if people could have bought at $1 million, now they can only buy 900,000. Housing prices are probably going to trend a bit downwards for the next little bit. In terms of a fixed versus variable, so still, this has no impact on fixed rates. Fixed rates are still between 5.3 and 5.5%. So we're still at a big discount off of the variable rates are still at a bigger discount off of fixed rates. But again, with another announcement coming in 2 months from now, or just under 2 months from now, we'll have to kind of wait and see what happens.
I mean, a lot of people were shopping at the top of their budget in 2020, where rates were really, really low. And we also had the stress test that they had to qualify at. But the stress test that those people had to qualify at is very close to where our actual rates are right now. And if we continue this trend even a little bit, it doesn't have to go up very much at this point. What happens to those people? Are those people now completely SOL and they're gonna, eventually foreclose because they shopped at the max budget they had and their stress test perceive them to have a threshold which we are now going to surpass?
This is a really, really good question. I've been asked that a couple times from clients who have renewals coming up in the next 6 months, 8 months, 10, or a year from now. What do we do? How do we requalify? So a couple different things. The first is these rules, these stress tests. The stress test was just implemented 5 years ago. The stress test increased about a year ago. So, the governing bodies can really play with this to make sure that clients are not put in this situation. The stress test is there today. Does it mean it's going to be there tomorrow? Absolutely not. These different ways, qualification rules, financing rules change so frequently that it's impossible to predict anything outside of 3 months from now, really. But the other thing to note is with the majority of lenders, when a client's renewing their mortgage, so if they purchased in 2017, let's say they purchased in October of 2017, and they're coming up for renewal in the next few months, if they did want to move lenders, yes, they would have to requalify. They would have to go through a similar process to what they had to do when they initially got their mortgage. But if they wanted to stay with their same lender, depending on, again, on these guidelines, if they do change, majority of the time, clients are able to sign a piece of paper saying, yep, I renew for another 5 years, no questions asked. So, which can be huge. You are subject to those lenders' rates and only those lenders' rates, and they can kind of play with that as they want. But the recommendation would still be to get in touch with a mortgage advisor, mortgage broker, somebody that you trust, and see, hey, does it make sense for me to re-sign with my current lender? Am I able to shop around? And if so, what's the best rate?
I deal with a lot of people who are upsizers. They have something to sell. They'd like to buy something a little bigger. A lot of the time they're selling a condo and upsizing into a freehold home. This is kind of, in a sense, grim for them because they can afford a lot less. What would you say to those people?
Try to do what works for you. This is the whole timing the market conversation. If it's time for you to upgrade, upgrade. If it's time for you to downsize, downsize. Rates will come and go.
I think the way that I would phrase it is the real estate market is like the weather. There's no such thing as good weather or bad weather, just inappropriate clothing.
Yeah.
All right.
I love that. That's
It can be a
great.
beautiful day outside. If you're in a poofy goose down jacket, you're gonna really not be enjoying yourself. And if it's a winter day and you're in a bathing suit, you're not going to be enjoying yourself either. So I think it's about being appropriately prepared and well educated on what's going on. I thank you so much for taking the time to chat. This is like really scary stuff in a lot of ways. I do have a lot of people asking me, is this going to crash the market? And I'm scared. What happens? Am I going to lose my home? What would you say? Just a final word on that.
Yeah, I would say, you know what, losing the home is kind of obviously the last resort for anybody. So even if lenders right now are accommodating, which is something that I haven't heard a lot about. Nobody wants to repossess a home. Nobody wants to go through that. It's very expensive for everyone. It's very expensive for the lender, and it's traumatizing for clients as well, for homeowners. So this is where it takes a lot of strategy and an education to make sure you're making the best decision for you. This is why talk to somebody who's in the industry. If you currently own a home and are worried, how am I going to make my monthly payments? Schedule a call with a mortgage broker, people that you trust. People will have conversations with you and offer you different tips, tools, techniques to make sure that not only you can afford the monthly payment, but you can afford to live on top of that monthly payment. So there are strategies. It's not all doom and gloom.
At the end of the day, even in a downward swinging market, you can decide with higher rates and lower prices if you'd prefer to wait, get a lower price, but pay money to the bank that you will never reclaim versus buying. And even if it goes lower, you're still going to reclaim that money in the long term overall as the market recovers, because real estate usually is a buy and hold strategy.
Yes, fully agree. Awesome.
All right, man. Well, thanks so much for the time. I really, really appreciate it. And I'll let you continue with your day because I'm sure it's a hectic one for you.
Oh boy. All right. Take care, Adam.
So this all kind of sounds doom and gloom in terms of the economy and also where we're heading with the housing market. And that's because it kind of is. Having said all that, where's the angle? What is the opportunity here? Before I say what I think, just want to let you know this is not financial advice. This is just my opinion on what I think is going to happen. Personally, I think this creates an amazing opportunity for investment condos in the downtown core. The reason why I think that is where the opportunity lies is simply because right now we have a lot of price adjusting happening and borrowing power is being slashed really aggressively. And when no one can afford anything, the only thing that everyone can usually afford is right at the bottom of price brackets. When borrowing becomes tight, the cheapest option usually becomes the most popular option. And the cheapest option in Toronto are condos. So while yes, we're in an inflationary environment and interest rates are climbing really quickly, of course, pricing is all going to be declining over the next little while. But in the next 6 to 12 or 18 months from now, we will definitely see the lower rung of price bracket products be the highest in demand because that's all anyone can afford. The other thing that I think is really important to note is that rental prices are at an all-time high. We are seeing an almost 20% year-over-year increase in rental prices in Toronto. So although a lot of people don't have extra money to be spending right now because we're in a tightening economy, if you do have money, I think the greatest place to be putting that money right now is in an investment property in the downtown core with a rental property condo. I think overall, you're gonna get the most bang for buck in terms of a lower purchasing price because you can really push sellers around right now in this market and also get a really high rent. I'm gonna shoot another video next week and go in a lot more depth about all of this, but please feel free to reach out to me if you have any questions. I'm always happy to chat. That's it for today. Stay safe.